Hey everyone, welcome back to my channel. It's Matthew Varga here. I am currently in sunny Florida, avoiding that Canadian winter, and it is gorgeous out today, so I'm really happy to do this video. In today's video, we are going to go over different types of investment accounts that you can open. So we're going to continue to build on our personal finance, investing, education. This video is part of a series that I'm doing to give you sort of the basic foundation for investing and all things personal finance. That way you can build your way up to gaining financial freedom. If you missed my other videos, my first video was a beginner's guide to investing, sort of an investing 101, breaks down all different types of investments, gives you a general overview of investing. We go over like a little bit about stocks, bonds, options. We talk about the stock market in that one. So that's a great beginning video to watch. And the other video was Stock Investing 101, where I actually go more in depth into investing in stocks. I talk about the stock market, how it works, and I actually jump on a platform and show you how to buy stocks. So if you haven't watched those two videos yet and you're still a beginner to investing, you might want to pause this video, go and watch those two first to really build that foundation up, and then come back here and continue watching this one, because that way some of the things we go over are just going to make a little bit more sense. If you're new to this channel is all about teaching you how to gain financial independence and retire early through saving, investing, and making money. Whether you're looking to do this with index funds or Airbnbs or traditional buy and hold real estate, we've done all of these different things over the last few years, and it's helped us retire in our 30s. If you're looking to gain more financial independence, make sure you subscribe to this channel so you don't miss out on future videos. And also follow me on Instagram and TikTok, where I do more daily posts on our investing journey. Please note that this video is meant to be an overview of the different types of investment accounts that you can look into, but you need to know that things change, rules change all the time, so make sure that you do your own research so you're getting the most up-to-date information. You can use this video to give you a good foundational knowledge of things, but you also want to make sure you're talking to your accountant, finding out what exactly you're qualified for, what benefits that you can take advantage of when you're building your financial plan. The one thing that you never want to do is to get the tax man angry. There are three main buckets of investment accounts that we'll go over in today's video. First, you have retirement accounts, also known as a tax deferred account. The second we have is a tax sheltered account. And the third one that we have is a non-registered account. Now, I know a tax deferred account and a tax sheltered account might sound like similar things, but there's actually a big difference between the two. So we're going to start with that first and go over what the difference is between those two. A tax deferred account, which is a 401k, a traditional IRA, or an RRSP if you're in Canada, is an account that allows you to postpone paying tax on funds that you've contributed into that account. These types of accounts were created by the government to help people save for retirement. Since the government has realized that our social security services are not really built to provide for everyone, they've built these tax incentives accounts to help people save for their retirement, so they're not going to have as big a burden on the social service system. So with a tax deferred account, when you contribute money into that account, that contribution becomes a tax deduction, which allows you to reduce the income on your taxes, which is going to reduce your tax burden for that year. That's where the term tax deferral comes from, because you're literally deferring taxes from now until a future time. The thought with this is that you're going to save taxes now where you're earning income, paying a higher tax bracket, and you're going to postpone that tax, defer it until a future time when you're retired, you're earning less income, and you're going to be in a lower tax bracket. So you're going to get that tax savings. For example, let's just say that you're working now, you're earning a good income, and you're in a 30% tax bracket. So you're paying 30% tax on all the income that you're earning now. The thought being that when you're retired, you'll be in a lower tax bracket, so you can withdraw those funds in that lower bracket, and you're going to save on taxes in the long run. For example, let's just say that you're currently working and you're earning a good income and you're paying about 30% in tax. That means if you're to contribute to your tax deferred account now, any contribution that you make is going to help you save on that 30% tax. Then when you retire and you're no longer earning that income, you're going to be in a lower tax bracket. So let's just say, for example, you're in a 10% tax bracket. So you made money, you contributed it at 30%. You got your tax deduction at 30%, you save that money, and now you're retired, you're pulling money out, and you're in a 10% tax bracket. Well, that means that you actually save 20% in taxes because you got a refund at 30%, you're now taking it back out at 10%, so you're saving 20% in taxes overall. Now, I don't know about you, but if I can keep more money in my pocket and less in the government's pockets, I'm pretty happy with that. So you can see how this can be a pretty advantageous tax strategy. Now, depending on the type of account, you might actually be able to utilize this strategy in years that you're maybe earning less income. Now, for example, in Canada with an RRSP, you can actually withdraw those funds at a different period of time, and depending on if you're in a lower tax bracket, you can save then as well. So for example, a few years ago, we went traveling around the world for a few years, so I wasn't actually earning any income at that period of time. So obviously I was in a very low tax bracket. So I actually took funds out of my RRSP in those years when I was in a low tax bracket and used those funds to help pay for some of my travels around the world. And I was pretty much paying zero tax on it. So that just gives you another example of how you can maybe utilize this in a different strategy. Now, with a tax sheltered account, you don't get the benefit of getting a tax refund with your contributions because the money that you're contributing to a tax sheltered account is after tax dollars, meaning you've already paid tax on it, so you don't get that same tax benefit you do with the tax deferred account. But the benefit that you do get with a tax sheltered account is the investments that you have inside a tax sheltered account and the profit and the money that you earn in that account is sheltered, so you're not going to pay taxes on that profit that you make like you would if it was outside of that account in a non-registered account. So you can probably see how having a tax sheltered account as well can provide some really great tax advantages. So having these two different types of accounts and putting the right types of investments in each type of account is really part of a good, solid financial plan. And you can probably tell by utilizing these different accounts and being strategic with what you put in, you can see how it's going to be the most tax advantageous to you. So it's definitely something that you want to focus on and make sure that you are incorporating that when you're building out your financial plan. So now that we understand the difference between a tax sheltered account and a tax deferred account, let's actually take a look at some of the different types of accounts that you can open within each of those buckets. So a lot of the information is going to be US related, and that's mostly because the US has a lot of different types of accounts in each bucket, whereas in Canada we really just have two types of accounts that you can set up, like a TFSA, tax-free savings account, and an RSP. So if you are from Canada and you want to learn more about those Canadian specific accounts, you can actually click down in the description box where I have the timelines there, so you can just click on RSP to see the information there and a tax-free savings to see the information there, because most of this is going to be for our US people. And also we have that third bucket, which is the non-registered accounts, which we talk about at the end, and that is the same for Canadians and US. So it's a great thing for you to listen to no matter where you're from. So we're going to start with the retirement savings account, which is that tax deferred account we talked about. So in the US, you have two different types of retirement accounts. You have an employee sponsored account and you have an individual account. The most common employee sponsored account that you can set up is a 401k. Most people have probably heard of that before. And then depending on which sector that you work in, there are some different types of employee sponsored accounts that you can set up as well. So if you're not sure what a 401k account is, Investopedia, which is a website out there that you can check out that has all different financial terms, breaks it down really well. So I'm actually just going to read what they say a 401k account is. A 401k plan is a retirement savings plan offered by many American companies that has tax advantages to the saver. It is named after a section of the US Internal Revenue Code. The employee who signs up for a 401k agrees to have a percentage of each paycheck paid directly into the investment account. The employer may match part or all of that contribution. The employee gets to choose among a number of different investment options, mainly mutual funds. So that's a great breakdown of what a 401k is. Other types of accounts that you could set up for employee sponsored accounts is a 403b. That's for public service people. So if you're a teacher, a professor, a government employee, nurses, doctors, librarians, you fall into that category. We've got the 457 account, which is offered for state governments, local government, and then some nonprofits as well. And then we also have a thrift savings plan, and that's for federal employees or people who worked in armed forces. So it's important to, talk with your HR, see which one of these categories you fall into so you can take advantage of it. There's also some of the categories you can benefit from both. You can take advantage of a 401k and maybe the TSP. So definitely want to talk with your HR at your company to see what you're eligible for. With most of these accounts, there is something called a maximum contribution limit. And what that means is that the government limits how much you can contribute to these accounts in a year. Let's be honest, the government's not that nice. They know that this is going to defer taxes and help you save on taxes, so they're only going to let you put in a certain amount and save just a little bit of tax. But any tax saved is a good thing, so you definitely want to take advantage of these accounts. So for this current year, which is 2021, the maximum contribution that you can put into one of these accounts is $19,500, or if you're over 50, you can add an additional $6,500, which is called a catch-up limit. So if you're over 50, you could actually put in up to $26,000 for the year. Now, if you're Canadian, we have the RRSP, Registered Retirement Savings Plan. That also has a contribution limit of up to 18% of your income, up to a total amount of, for 2021, $27,830. So for example, if you're making $50,000 in the year, you're at that 18%, that means you can contribute up to $9,000 into your RSP. So you might have heard when I was reading that description of the 401k from Investopedia, it was talking about employee matching your contributions. So if I was to tell you that you could get some free money, I'm sure you'd be all for it. Well, that's the idea behind the 401k employer matching program. Your employer will actually give you free money as part of your compensation. So with an employer match program, they'll actually match a percentage of contribution that you put into your 401k. So it could be a 3% matching, 4%, 5%. It really depends on the company that you work for. In Canada, we also have something called the RRSP matching. So it's very similar to that 401k match. So it's definitely something you want to look into to see if your employer provides that employee match program. So in order to get this free money, you first need to contribute from your own salary into your 401k program. And then based on the rules that your company has, they're going to match that amount up to a certain percent. For example, let's say your employer has a 4% matching program and you've got a weekly salary of $1,500. That means that your employer will match up to a maximum of $60 per week. If you were to contribute $60 into your 401k, your employer is going to match your $60 and contribute that as well. So you're actually going to contribute $120 into your 401k each week. Now, I know for some people, maybe $120 a week doesn't sound like a lot, but over the course of a year, that's going to come out to $6,240, and half of that is free money. So if you work for a company that offers a 401k matching program, you should definitely set that up and get started on it, because it's a great way to fast track your retirement savings plan. If you don't know what your company has, once again, like I said, go talk to your HR, get that appointment set up and figure it out and see if you can take advantage of that free money. Here's a couple of important points to keep in mind so you can maximize your 401k. First, set your contribution limit so you can take full advantage of your employee matching program. Second, start contributing to your 401k as soon as possible. Third, look to increase your 401k contribution regularly until you hit that max point. Fourth, you should also make sure you understand your employee vesting period for your 401k. And the fifth thing is, if you are switching jobs, you want to make sure you're looking into what you can do to roll your 401k. Now, I know for some people out there, you're probably saying, well, my employer doesn't offer a 401k program, so what do I do if I don't have that ability to set up a 401k with my company? Well, the good news is that there is another type of account that you can have set up if your employer doesn't have the 401k, and that is known as the traditional individual retirement account, also known as an IRA. This account, the IRA account, was set up for people who don't have the 401k with their employers. That way you can at least get some of the same tax advantages that you get with a 401k. So this traditional IRA works very similar to the 401k. The big difference is that you're not getting employee matching with an IRA, but you do get that tax deferred status that you get, same as a 401k. So you do get to reduce your taxes owing and get a little bit of a tax benefit on contributions to your traditional IRA. The downside with the traditional IRA is your contribution amount is lower. You can only contribute up to $6,000 per year or up to $7,000 if you're over 50. Now, another important thing to know with these retirement accounts, depending on the one you set up, is that there are some withdrawal rules and limits that you have where a lot of these accounts you can't withdraw funds until you're 59 and a half years old because they are retirement accounts. If you do withdraw early, you can be faced with a 10% penalty. So that's important to know. And another point to know is that the government only lets you postpone taxes for so long. So once you hit 72, you do have to start withdrawing money from these retirement accounts, and you have what's called a minimum withdrawal rate. So you actually have to withdraw a certain minimum amount each year once you're over 72. I mean, the government's not going to let you save taxes forever. This minimum distribution amount or minimum withdrawal rate, whatever you want to call it, it does change every year. The rules are always changing. So you definitely want to make sure that you're up to date with what the current rules are. Talk to your tax professional and start preparing for that future, especially if you're getting close to that retirement age. Finally, if you're between the ages of 59 and a half and 72, you're kind of in that sweet spot where you can start to withdraw money from your retirement accounts, but you're not actually forced to withdraw a minimum amount. So this is sort of that sweet spot where you can take funds out. You're not going to pay any penalty on it. So you can probably use this time period to really be as tax efficient as you can. So work with your professional and make sure that you're maximizing these tax benefits. Now, once you start withdrawing money from these retirement accounts, it does get added to your income for the year. And depending on what tax bracket you're in, you're going to pay tax on that amount that you've withdrawn. And as I mentioned earlier, if you take funds out before you're 59 and a half, there's also going to be a 10% penalty. So you want to be aware of that. There are a few exceptions where you can withdraw from your retirement account without getting penalized as 10%. So here are some of the exceptions that you can look into to see if you qualify for it. One, if you're attending a higher education, so you're going to school and you need some funds for your education. The second option is if you're purchasing a home. So at the time of this recording, you could actually take out $10,000 to help fund a purchase of a new home. Or if you're married, you could actually each take out $10,000, so that's $20,000 total. If you had kids, you can also do this withdrawal to help them purchase their first home, which I'm sure they'd be thankful for. A couple of the other exceptions that we currently have is if you birth or adopt a child, you can take out up to $5,000 to help cover that cost. There's also some exceptions for medical expenses or health insurance premium. So those are just a few examples of times that you could possibly take funds out without having that 10% penalty. If you are looking at one of these exceptions, just talk to your tax professional, make sure you're eligible for them and you fit within the rules. That way you're not hit with that penalty and surprised by it, because that wouldn't be fun. So that was the breakdown of our first investment account bucket, the tax deferred retirement account. I know we went over a lot in that section, so feel free to watch it again if you want to get a bit more clarity on some of the things that we covered. But we do have another bucket to discuss, which also has some tax advantages to it, and that is the tax sheltered account. This tax sheltered account is also known as a Roth IRA in the US, or if you're in Canada, it is known as the tax-free savings account, the TFSA. So a Roth IRA is different from that traditional IRA or that 401k we talked about, because a Roth IRA is not a tax deferred account. So you're not going to get a refund on your taxes for contributions. Any funds that you put into a Roth IRA, you've already paid tax on, so it's after tax dollars. Now, the benefit to you with a Roth IRA is that the investments that you have in that account can grow tax-free. If you were to invest in stocks in your Roth IRA, and let's just say you had a great stock pick, it just blew up and you made $10,000 in profit off of that stock, within that Roth IRA, it is not taxed at all. So that growth that you're making inside the Roth IRA is avoiding taxes until you withdraw it in the future. For example, if you made that same $10,000 outside of this tax sheltered account in just your normal non-registered trading account, you would have to declare that $10,000 profit that year to the government and pay your tax on it. So you can see how by investing within these tax sheltered accounts, you can grow that money tax-free and it's going to compound on top of each other. And that's where the real benefit lies, in these tax sheltered accounts. Just like your traditional IRA, there are limits to how much you can put into this tax sheltered account. Once again, the government is not that nice. They don't want you to save taxes. They want to get their money, but they do give you this little crumb so you can save a bit. So with the Roth IRA, your maximum amount you can contribute for this year, 2021, is $6,000, or if you're 50 and over, it can be $7,000. Obviously, it would be great if there wasn't this limit put on these accounts. That way you could put a lot more money in and grow it tax-free. But you can see how over time, if you're contributing that $6,000, $6,000, $6,000, it can really come out to quite a large amount of money. And once again, it's growing tax-free. It's important to know that with a Roth IRA, the contributions that you put in, you are allowed to withdraw that at any time. But the profits that you made within that Roth IRA, you can't withdraw until you're 59 and a half, the same with your traditional IRA. If you do withdraw it early, you are gonna pay a 10% penalty on those withdrawals, very similar to the IRA that we talked about earlier. There are some exceptions to the rules, the same as we talked about earlier. So you definitely want to take a look at that to see if there's anything that you might qualify for to allow you to withdraw funds early and not pay that penalty. Now, for my Canadians, we have the tax-free savings account, the TFSA. Now, I think this is one section where Canada actually beats out the US when it comes to tax advantages. In general, I think the US has a much better investor-friendly tax code than we do. But with this TFSA, I think we actually just have a little bit better than the Roth IRA. Now, the tax-free savings account, you are also using after-tax dollars to fund this account, and those investments can grow in there tax-free. But the big difference between our tax-free savings account and that Roth IRA is that you can withdraw funds from your tax-free savings account at any time. There's no penalty. So in that example I talked about earlier where you made $10,000 in a year off of a good investment pick, you could take it out that year, pay no tax. So, I mean, really, you can see how this tax-free savings account can be a huge tax benefit to you as an investor in Canada. So you should definitely make sure you look into that and get that set up, because you can grow your investments tax-free, pull it out anytime and use those funds to, I don't know, party, have a good time, buy a boat, do whatever you want to do. Now, a tax-free savings account does have a maximum limit that you can contribute. Same as the US, we are not that generous in Canada. We will only let you save a certain amount of tax. For 2021, that maximum contribution that you're allowed to put into a tax-free savings account is $6,000. Now, the good thing with these contribution limits is that they do carry forward and build on top of each other. So if you haven't contributed to a tax-free savings account and you're over the age of 18, and say you turned 18 in 2009, which is when this account came into effect, you could actually put in $75,500 today into your tax-free savings account, start investing with it, and start making money tax-free. All right, so the third bucket that we have, and this is the same for both Canada and the US, is the non-registered account. So as the name sort of alludes to, the non-registered account means it's not registered with the government in any way. There's no tax advantages, there's no tax benefits to this account. So any money that you make in this account, whether it's capital gains or dividends or interest income, you have to declare that with the government this year, the year that you made that profit, and you have to pay your fair share of taxes on it in that year that you made that profit. Now, depending on the type of investment that you make and the type of profit that you earn, there might be some tax advantages based on the type of income that you earn. So for example, in Canada, if you made a profit on a capital gain, you're actually only taxed on 50% of that gain. Or if you're making dividends and they're from qualified Canadian companies, you can actually get a dividend tax credit for that, and you're going to pay a little less tax than you would on some other types of investment income. As you can see, different types of income earned in a non-registered account might have a little bit better of a tax advantage than other types of income. Now, I'm not going to get into the crazy world of taxes in this video, but you should definitely talk with your accountant or your tax professional to figure out which types of investments make the most sense in different types of accounts, so you can avoid paying legally as much tax as possible. So there you have it. Those are the three different types of investment accounts that you can have set up for yourself to build your financial plan. You're probably asking yourself, well, which of these accounts should I set up first? What makes sense for me? I'm going to give you a bit of a step-by-step flow of the types of accounts you might want to focus on first. Now, obviously, I don't know your individual needs, so you want to, talk to your accountant and figure it out. But here's just a general idea of what I would look at first and kind of work my way down from there. So the first thing that you should look to set up is you should look to see if your employer qualifies for the 401k or an RSP and has that matching program that we talked about earlier. This is the best one to focus on first, because if you can get that employee match, you're going to get that free money from your employer, and you want to make sure you're taking full advantage of that first. So if I had the ability to do a 401k match, I would make sure that I was putting in the maximum amount that I could that my employer is going to match. So if they're going to do a 5% match, I would make sure I would hit that maximum of 5% first, so I'm getting as much free money as possible. The next thing to look at is if your company doesn't offer that matching program, doesn't have a 401k or an RSP matching plan, and you're earning a good amount of income, so you're in a higher tax bracket, then you should look at setting up that traditional IRA, or in Canada, just a straight up your own RSP savings plan. The next thing to look into, if your company doesn't offer that matching program, doesn't have a 401k or an RSP account, then you'd want to set up your own individual retirement account. So you'd want to set up that traditional IRA or your own RSP account. Now, when you're looking at doing this, you want to make sure that you're in a higher tax bracket. So if you were in the lowest tax bracket, so you're only paying 10% tax, it probably wouldn't be beneficial to set up this type of account, because you're not really getting the benefit of it, which is that tax deferral into future years. But if you're earning a pretty good income and you're in a higher tax bracket, then you definitely want to make sure that you're setting up these traditional retirement accounts, because you're going to get that advantage of saving your taxes today when you're in that higher tax bracket, so you can withdraw it in the future when you're in the lower tax bracket. The next thing to look at after you've maxed out those tax deferred accounts is you want to look at setting up those tax sheltered accounts like the Roth IRA or the tax-free savings account, and you want to start putting your next amount of funds into this account so that you can continue to grow your investments tax-free. The other person this might be beneficial for is if you're not in that higher tax bracket and you're in that lower one, then you might want to start here at this Roth IRA tax sheltered level. That way the investments that you are starting and you are getting going are growing tax-free, which is going to be advantageous to you over the years. Now, if you are in that lower tax bracket, you might want to look at just starting here at this Roth IRA tax-free savings account level, because like I said before, you're not getting the benefit of deferring your taxes. So this is probably where I'd want to start if I was, in that lower tax bracket level. That way, those investments that I'm starting today are going to grow tax-free, and I'm going to get the advantage of those tax sheltering, which is a great place to start. Finally, let's just say you've maxed out your 401k, you've gotten all that free money from your employer, you've maxed out your tax sheltered account, or you've started there and you've maxed that out. The next thing that you can set up is that non-registered trading account. As I said before, this account, you do have to declare the income, you do have to pay taxes on it. This is the last place that you can put your funds, so you can keep investing and keep growing your wealth. So if you're fortunate enough to max out all those other accounts, you can put your funds into this non-registered account, keep investing, and once again, just see which types of investments make the most sense in this non-registered account, so you're paying the least amount of tax possible. There you have it, the 3 different types of investment accounts that you can look into when getting started with investing. This video was meant to give you an overview of these different types of investment accounts that you can set up. That way you can start to build your financial plan and start working towards your financial future and planning for early retirement. Saving on your taxes is one of the best ways to cut down on your expenses. Now, I know you'll always hear those things talking about, cut out eating out and cut out your daily coffee. And these are good too, but you're probably gonna get a lot more bang for your buck by focusing on saving on your taxes and reducing your tax expense each year, because let's be honest, a large amount of your income goes to taxes every year. As I've probably said 100 times in this video, it's always best to talk to your tax professional, work on that plan so that you can legally avoid paying as much tax as you can. One of the key things that rich people do to stay rich is they use that tax code to their advantage. They use those legal loopholes to avoid paying as much tax as possible, keep as much money in their pocket as they can, and use that money to invest and to keep growing their wealth. This is one of the main secrets of being rich, and I hope this video inspires you to do the same for yourself. I hope you enjoyed today's video. Make sure you give it a big thumbs up. Subscribe if you're not already subscribed so you don't miss out on those future videos. And leave a comment down below with any questions or comments you might have, and I'll be sure to answer you down there. Thanks again for watching, guys, and I'll see you next week.